Coming up on the Purpose-Based Retirement, 4 tough questions you should be asking your financial advisor. Are they investing their hard-earned money like they're recommending you invest yours? And is 2018 the year the stock market crashes? Coming right up.
Welcome to the Purpose-Based Retirement with certified financial planner practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience, helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you face, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Welcome to the program. I'm Lee Kelso here with Casey Weade, certified financial planner and the president at Howard Bailey Financial. You know, this time of year, many people are thinking about setting their lives in a different path for their finances, and you may be out in talking to advisors. And that's one of the things we want to start with here today is, how do I select an advisor for the important elements of my financial life?
Sure. This might be the year you retire. It might be the year you start saying, well, now I'm going to roll over my 401k, but I'm not sure exactly how to manage it. Or I need a tax strategy. All of a sudden, you're getting ready to file your taxes this year, and you feel like you paid too much in taxes last year. Well, maybe it's time to sit down with somebody that really knows what they're doing and can pull all these different pieces of the puzzle together and put together a true financial plan for your future. And if that's the case, I think there's a couple things we should be thinking about. One, let's go around a little bit, right? Let's shop around. Let's see at least 2 or 3 different advisors and make sure we're sitting down with someone that we can really not only put our trust in, but hopefully someone that we know we can have a relationship with for the rest of our lives. It's, in your accumulation years, you might only be looking for someone to help you get a piece of the market and start to grow your assets and fill in some gaps. But when it comes to retirement planning, you don't want to be left looking for a financial advisor when you're 80 or 85 years old. This is a lifetime commitment, so we take it very seriously, and I want to lay out some really tough questions that you should be asking along this path.
Good, let's just jump right in here. First and foremost is fees and expenses. And what we've got here for you is, why is it important that I ask, how much will this cost me, and not how do you get paid?
This is one of my biggest frustrations with the financial industry is they say, oh, we're going to show you all the fees in black and white. We're going to put this beautiful commercial together that shows you how good we are at full disclosure of our fees and expenses. And then we get those same individuals to come in our office and we find out they really don't know what they're paying in fees and expenses because there's still all this smoke and mirrors that's next to impossible to get around because of the mutual fund industry more than anything else. One of the things you can do if you own mutual funds and you want to see if you have too much in tax cost, too much in internal expenses, 12B1 fees, if you have too much, let's say, in trading costs and turnover, this is going to make a lot of advisors angry. So go to personalfund.com and screen your mutual fund, and it'll show you the different alternatives. It's a service that we pay for in our office to make sure we're always using the lowest cost options that are out there, because it matters how much it costs, whether you're buying a TV or a computer, or more importantly, your retirement.
So let's talk about some of those costs and take those apart. Now, you mentioned the hourly rate, so obviously I want to know, is it going to cost me when I pick up the phone?
Exactly. Yeah.
And then also advisory fees. How's that different than an hourly rate?
Yeah. Well, sometimes there's advisory fees. There's kind of 3 different ways that advisors typically get paid. There's fee-only advisors that only collect a fee. These are typically in the way of hourly rates or an asset under management cost, say 0.5%, 2% a year, whatever that might be. And then you have commission-based advisors that we're starting to see fewer and fewer of these in the industry, but now these are largely insurance-based organizations or even brokerage houses. Still, the biggest wirehouses in the country are still commission-based advisors because they carry a Series 7 securities license, Series 66, and that structure has inherent problems, right? We make 5% up front. Now we don't have any incentive to help continue to grow that portfolio into the future, especially if we're taking risk with our life savings. That's a scary model. The blended model is the fee-based model, where if we're taking risk with your life savings, we're fee only. You make more money, we make more money, you lose money, money, we lose money. It ties our interests together, but we can still do some of those risk-based strategies that can guarantee your income for the rest of your life, or protect you against any major long-term care expenses or any debts if you pass away, for that matter. Risk management is a huge part of retirement planning. That's why I don't recommend working with a fee-only advisor for your retirement plan.
Good point. And we talked a little bit about the commissions and internal expenses. Those are often very difficult for people to understand, aren't they?
They are, and that's why we recommend going to an advisor that can x-ray that portfolio and actually look inside and say, what types of expenses do I have going on in here?
So the other important question that I think everybody needs to focus on is, are you limited? Are you a captive agent?
Yeah, well, I started off that way. Marshall Johnson, our vice president, started off that way. Most advisors start with captive organizations, and that's one of those things that I did. I started with a captive insurance company where I was only able to sell the products they told me that I could sell. And it wasn't the right thing, but it was the only way that I could get paid. Marshall, the same way. He started off as a mutual fund only advisor. He could only use one tool. When we start building strategies for the goals that you have for retirement, we better be using more than one tool. Otherwise, we're not getting true diversification. His clients had no protection during 2008, and that's why he joined our firm, to lower his clients' costs and also provide them with more tools.
I think people are going to be surprised to learn that education in the financial industry isn't as as structured as some people might think it is. It's not tough to become a financial advisor.
Right. Unfortunately, it's not. You can run out and get a securities license or an insurance license in a matter of a couple weeks, and now you're advising people on your life savings. You wouldn't work with a physician without an MD. You shouldn't be working with a financial planner without some type of formal education. One of those areas we could go is certified financial planner. That's going to provide the highest level of education today to financial planners. If you're looking for a retirement advisor, retirement income certified professional is a great designation to look for. That's the only formal education for specifically retirement income planning in the industry today.
So the next question that's very important is one that you may not be thinking about, and that is, how long are you going to be around? Well, you told me 35% of advisors are soon to retire.
Yeah, the average age of an advisor today, according to Cerulli Associates, is 50 years old. The average advisor is going to be retiring. 35% of those advisors are going to be retiring over the next 10 years. I want to make sure the person I'm working with is going to be around for a long period of time, so I'm not looking for a new financial advisor at a critical part in my financial life. And that is a large reason we see a lot of new clients, is their advisors are passing away or they're stepping into retirement and they're ready to sit down and work with someone. They say, I don't want to go through that again. Let me work with someone that's going to be around for a very long period of time. And then if you've got even a young financial advisor, you want to make sure if they get hit by a bus, they've got a succession plan, right? So if something happens to me, I want to know that my clients are taken care of and our business continues on running. We had that situation here at the end of last year. We had a sick child and we spent 6 months out of the state, and we had Marshall Johnson, Ryan, we had Rob, our advisory team, our whole team came together, continued to grow our business and take care of the families that we work with. And I think due to us being gone, our business actually grew faster, because now everybody knows, well, they don't necessarily have to have Casey.
Yeah. Good and bad on that one, huh? So the other important question to ask, and this one seems obvious, but I know people are going to be hesitant to say, open your portfolios, show me how you invest your money. I want to see you buying the same products you're selling me.
Yeah. Well, I think it's unusual that we're going to sit down with you and ask you all of these very difficult financial questions and ask to see your portfolio and you naked, basically,
yeah.
Right? Well, why wouldn't you ask your advisor the same thing? Why wouldn't you ask them, well, you just recommended this annuity, you just recommended this mutual fund, this managed portfolio, this stock, this life insurance policy, do you have it? And if you don't, why don't you have it? Yeah. And don't be afraid to ask to see a statement. All they can say is no.
Good deal. All right. We hope that helps you. The right questions to ask if you are trying to find a financial advisor to guide you through the difficult years ahead in retirement. All right, we're back with questions from viewers in just a second.
Today, Casey is making this very special offer, a consultation with the Howard Bailey team. Are you prepared to stand up to retirement's most significant threats? It's a comprehensive education about your money, and your consultation is complimentary. See what you really pay your current advisor. Optimize tax savings and maybe increase your cash flow. Get more benefit from your benefit. Learn proven wealth strategies and techniques to help you feel more secure. Spend in retirement with confidence. Eliminate guesswork. Get answers from the team's fact-based approach. Make better decisions. Meet your financial objectives. Rise to your financial challenges. Call the number on your screen right now. Make your appointment. Let Howard Bailey Financial put you on the path to your very own purpose-based retirement.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out.
Welcome back. This is a segment where we always answer your questions, and today we're going to start the program bouncing up to Granger, Indiana, and Adele. Go right ahead, Adele.
Hi, my question is, can I spread the death benefit payout to my beneficiaries and reduce the cost of my life insurance?
That is such a really interesting and unique question that you have there, Adele, that most people don't think about. But that is something that in today's world of life insurance, you have the opportunity to do. Life insurance policies have changed dramatically over not just the last 5 to 10 years, but I mean, think about how much they've changed over the last 20 to 30 years. There's things that you can do such as this. And this came out of the demand for, one, lower cost of insurance. So we spread that death benefit out upon the death of you or a loved one. That beneficiary now will get periodic payments, kind of like winning the lottery, right? You have the option to take a lump sum, or you're forced maybe in some instances to take it out over a period of time. You know, rather than getting $500,000 in a lump sum, they might get $50,000 a year for the next 10 years. And by structuring your life insurance policy that way, you can dramatically reduce your cost of insurance, your actual premiums for one. If this was done with something like a term insurance policy, where it's just purely about death benefit, you want a low premium, but you want to make sure your family's taken care of, great option for you in that scenario. Another option that I've used it for personally is for cash value growth or a tax-free income strategy, where I want to keep the cost of insurance very low. It's largely meant to create tax-free income upon our retirement. So we're putting dollars into this policy so that we can also ultimately get them back in the form of tax-free income. So I don't care how big that death benefit is. I want it as small as possible. And another way I can minimize the cost, not just by making it small, is to also spread that death benefit out over a period of time, such as 20 years. And that dramatically reduces that cost of insurance and unleashes really the cash value growth part of that policy, the tax-free growth that is the reason that I'm doing that. And so there's a lot of different reasons that you might do that. However, Adele, there are very few carriers, insurance carriers out there that are offering these types of policies. So if you're working with a captive agent that maybe works for an agency where they can only sell a few products or can only sell the products that their company manufactures, you might need to look outside the box and look at an independent firm that can shop all those different carriers, because there's really only a handful of them out there that have really taken that step to create things and utilize things such as this. I had an advisor the other day that had asked me, why is it that our companies aren't offering the same products that you guys are? This seems silly. These are such great deals for the client. Why wouldn't we be doing that? And I say, when new things come across like this, when we have life insurance that allows you to spread your death benefit and lower your cost and control the benefit to the beneficiaries without trust documents, that's a great vehicle. But these big old financial firms, it's kind of like a big old cruise ship, right? It's going to take them a long time to turn that thing around if you forgot something at the dock. So you have to work with someone that's a little bit more nimble on their feet, and an independent advisor can provide you the latest and greatest tools such as this that might be the perfect fit.
All right. Hey, good question, Adele. Thanks for asking. This one came to us via email from Terry here in Fort Wayne. Terry writes, I'm maxing out my 401k. Where else can I turn for tax-free investments?
Oh, that's a tough one, right? You know, I mean, everybody wants to have tax-free investments. Nobody wants to pay more taxes than they're really required to. However, that's one of the problems with saving dollars for retirement, especially if we have a lot to save every year. We put money in our 401ks, maybe our IRAs, and maybe then we go, well, now what do we do? You know, we could potentially end up building up this big old taxable bucket of funds where we're getting taxed on these funds every single year. We're having to pay taxes on money we're trying to save for the future, and we're not spending those dollars today. How do we tax shelter them? One is obviously your 401k, especially if you have a Roth 401k at work. Now you've maxed that out. Where do you turn? You might look at an HSA if you have a high deductible health plan. You might also look at a 529 if you're saving for college. But after that, there are very few options. The only other option might be something like we discussed previously. Something that I use is a life insurance policy with a very low death benefit, and now I can take tax-free income from that in the future, and I expect similar rates of return. Look at whole life policies out there today. Some of those generating 2 to 3% net rates of return to the client, and that's a safe place that might pay you better interest in the bank and be tax-free. If we go and take that a step further, maybe index universal life paying 3 to 6%, 4 to 6% tax-free. That might be a good alternative to investing in your Roth 401k. Now your Roth 401k is going to give you more long-term growth potential because you're going to be investing in things like ETFs, index funds, maybe even mutual funds if you can find one that's low cost enough, stocks and things that offer much greater growth potential than you might find in a life insurance policy. But I find when you get to this point, you've maxed out your 401k, it's time to sit down with a tax advisor that knows all these tools, and especially someone that's gone through it themselves.
Yeah, our next question is from Ronnie up in Niles, Michigan. Also has to do with tax. Ronnie, it's up to you.
My question for Casey is, how much tax will I owe when I inherit my parents' farmland? Thank you.
Ronnie, great question, and one that a lot of individuals have. Most people that inherit farmland are going to get a step up in basis, just like you would your stock portfolio. When you have a stock that you inherit that had a low cost basis, it gets a step up to the date of death value, and then your beneficiaries can sell it with that much higher cost basis, so they don't have to experience those capital gains. One of the things that you have to be careful of when it comes to farmland is putting it into a business type entity like a family limited partnership or an LLC. You might lose some of those tax benefits, that cost basis step up. And some families have done this in order to pass assets on to the next generation or to avoid potential long-term care costs, qualify for Medicaid. And that is a great thought. However, what happened was you worked with an estate planning attorney and you didn't work in conjunction with your CPA and your CFP. You didn't have a team that was taking all that information and saying, okay, this is a great tool for us to use for this purpose. However, these are things that we need to watch out for when it comes to taxes or when it comes to investment growth, when it comes to our income. All those things have to be brought together, and this is a great example of that. So hopefully you'll get a step up to the date of death value, and any further gains will be capital gains.
All right. Hey, thanks for all those good questions. If you have a question you'd like to see us answer here on the program, you can send it to info@howardbailey.com. Now, we have a question for you, our question of the day. What is the average consensus from Wall Street on where the S&P 500 will land by the end of this year? We'll have the answer when we come back.
Today, Casey is making this very special offer, a consultation with the Howard Bailey team. Are you prepared to stand up to retirement's most significant threats? It's a comprehensive education about your money, and your consultation is complimentary. See what you really pay your current advisor. Optimize tax savings and maybe increase your cash flow. Get more benefit from your benefit. Learn proven wealth strategies and techniques to help you feel more secure. Spend in retirement with confidence. Eliminate guesswork. Get answers from the team's fact-based approach. Make better decisions. Meet your financial objectives. Rise to your financial challenges. Call the number on your screen right now. Make your appointment. Let Howard Bailey Financial put you on the path to your very own purpose-based retirement.
Let me help you create the retirement you dream of. Go to my website and pick one of 3 education options to get started today. Get a copy of one of my retirement planning books, sign up for a purpose-based retirement live event, or go to the Purpose-Based Retirement University. 2 days of college-level retirement planning instruction. With the right education and proper coaching, I believe anyone can create the retirement they dream of. It all begins with one step. Visit thepurposebasedretirement.com.
Well, let's see how you did with our question of the day. Going into the break, here was our question. We asked, what is the average consensus from Wall Street on where the S&P 500 will land by the end of 2018? Casey?
Well, Lee, everyone wants to know, is this going to be the year that the stock market crashes? Are we going to experience another 2008 or another 2001? What is the future going to look like? And economists and wealth strategists from the major banks across Wall Street are telling us this throughout the past. We're going to get to the question of the day in just a minute, but let's see how well they've been doing at predicting the future throughout the past. If we go back to 2008, they predicted the S&P 500 would end up at 1632. By the end of the year, it was at 903, a 38.5% loss. They were only off by about 50%. Go back to 2002, they projected an end of the year number of 1291. We ended up at 880, a 23% loss. They were off by about 35% in 2002. Now let's take a look at 2017. In 2017, they projected the S&P would end up at 2362, actually ended up closer to 2700. Instead of a 5.5% gain, it experienced a 20% gain, and that was putting them off by about 14% just last year. Now we're seeing projections for 2018 to be fairly positive. Once again, what a surprise. We see 2854. That would be answer C from our question about 2800. The number is 2854 for major Wall Street economists, and that puts us at a 6.4% projected gain for 2018. Now, is that really going to be the case? If it is the case, if we actually see these numbers come to fruition, this is going to put us in the longest bull market in history. We had the dot-com bubble. Right before the dot-com bubble burst, we were in the longest bull market in history. If we make it through this year and hit these numbers by the end of the year, we're going to find ourselves in the longest bull market we've experienced throughout history. Unfortunately, Wall Street strategists, they don't always get it right. These orange lines that you see here are the predictions of analyst forecasts from major Wall Street strategists from 2000 through 2017. The blue lines are what the market actually did. So it's pretty obvious from this chart that they don't get it right every single time, and they tend to always predict gains on the eve of bear markets. Think about it. When you're manufacturing financial products that are going to benefit from market growth and you're trying to sell those to your clients, you're trying to sell those to individuals at your banks, where do you want the market to go in the future? If you project the market to go down over the next 12 months, well, you're probably not going to get nearly as many sales over the next 12 months. And that's the issue with working with firms that are only selling you products that are related to what happens in the stock market over the next 12 months. We want to make sure you can succeed regardless of what the Wall Street strategists not only say, but what actually happens. Because on average, they are off by about 20%. That is their forecasting error year to year. This is one of the things that we need to be concerned about in 2018. We're going to talk about a few of the things that could make these numbers not come to fruition. One is the decline in reinvestment that we're seeing from not just the Federal Reserve here in the United States, but Fed banks across the entire world are seeing a dramatic reduction in the amount of dollars they're reinvesting back into their economies. In the U.S., the Federal Reserve makes up about 25% of our gross domestic product, and we're expected to see fading reinvestment and rising interest rates throughout 2018, putting stress on the stock market and the economy. Now, if we also take a look at another number that a lot of economists as well as financial advisors are looking at, that would be the valuation of the markets today. We can find ourselves crossing just now into the second most expensive market in history. We've just crossed Black Tuesday, which was right before 1929, the Great Depression, of which the market lost over 80%. And we may actually be approaching, we passed the 2008 levels of market market pricing, and now we might actually get all the way to what we saw in the tech bubble of the early 2000s. And if we look forward at what those rates of returns could potentially be into the future in the S&P 500 and the equity markets, whenever we've reached valuations, those orange dots on your screen represent valuations on that 30 plus level, the bottom right hand corner of your screen. We have seen forward returns be negative over the following 10 years, anytime we've ever seen levels of valuation as high as they are today. If we look at throughout history and what types of returns can be expected moving forward from these valuations levels, we may see 2 to 2.25% in forward returns. However, the capital gains are actually negative. That means that the growth is coming from the dividends that you can experience over the coming years, and this is why we really want to emphasize the importance of always generating dividend income, always generating interest income, always making sure your portfolio is receiving some type of growth in case the economy doesn't grow for an extended period of time. If we look at the top 7 bull markets, we can see after every single one of the top 7 bull markets throughout history, we've subsequently seen losses that have averaged 51% after about a 282% average gain, which is where we find ourselves about today. This was as of April of 2017. We're just getting even closer and closer to becoming the longest bull market in history. Some of those subsequent declines have been as deep as 86% from peak to trough, and as not so bad as 22%. That means your $1 million portfolio just turned into $800,000. That means your $1 million portfolio just turned into, say, $200,000. Can you go through those types of losses, and do you have the time to make them up? Because the time it takes to recover from markets such as this, when we see major pullbacks, can be extended. You might be familiar with the lost decade. If we factor in inflation, it actually took 14 years to get back to even. 23 years, 29 years, 21 years have been the time to get back to even after major pullbacks following major bull markets throughout history. The question is, are you hoping for the best and planning for the worst? Because too many retirees are hoping for the best, and they're also depending on it in order to be successful. In other words, does your retirement depend on consistent market gains? Does the market have to do consistently well for your retirement plan to succeed? Because if it does, you're focusing too much on hope-so strategies. You should be planning for the future and making sure you're going to be successful regardless of the worst. If you look at your portfolio and you go, well, my advisor said I've got a 90% chance of success that I'm going to be able to make it not only to, but also through retirement, what's that 10% odds of failure, or that 5% odds of failure? Because now we're in one of the most expensive markets in history, in the top 5 to 10% of most expensive markets. That might put you in that position in the near future.
Yeah, and that's a position that makes me very uncomfortable with the amount of time it's going to take to recover from one of those big sell-offs. I don't have that much time in my retirement life, and if you're feeling that way as well, I hope you're working with a retirement-focused advisory firm. You can learn more by going to thepurposebasedretirement.com. You can info@howardbailey.com to reach Casey with an email question, and we hope we'll see you next week.
Today, Casey is making this very special offer, a consultation with the Howard Bailey team. Are you prepared to stand up to retirement's most significant threats? It's a comprehensive education about your money, and your consultation is complimentary. See what you really pay your current advisor. Optimize tax savings and maybe increase your cash flow. Get more benefit from your benefit. Learn proven wealth strategies and techniques to help you feel more secure. Spend in retirement with confidence. Eliminate guesswork. Get answers from the team's fact-based approach. Make better decisions. Meet your financial objectives. Rise to your financial challenges. Call the number on your screen right now. Make your appointment. Let Howard Bailey Financial put you on the path to your very own purpose-based retirement.